Welcome to this explainer. Today we are unpacking a massive, truly fundamental shift in the world of global finance. If you follow international markets, you've probably heard whispers, or maybe even some loud groans, about a regulatory earthquake that officially struck on January 1, 2023. We're talking about an international accounting standard that completely rewrote the rules for insurance contracts. It's called IFRS 17, and let me tell you, it has ushered in a completely new era of global insurance transparency.
But before we get into the heavy lifting of the standard itself, let me just ask you this. Ever wonder how insurance companies around the world actually report their financial health? Really think about it for a second. This is a trillion-dollar global industry built entirely on promises. You pay a premium today, and the insurer promises to pay out if something goes wrong 10, 20, or 50 years from now. So how on earth do you accurately track profits, risks, and liabilities over such a massive, completely uncertain timeline? Well, for decades, the answer to that question was surprisingly messy. Okay, let's dive into this. Here's our roadmap for today. We'll start with the IFRS 4 patchwork, then enter IFRS 17, unpack the CSM, look at forward-looking risk adjustments, tackle the transition challenge, and finally, wrap up with the new era.
Right, so, Part 1, the IFRS 4 patchwork.
The journey to fix insurance accounting was painfully long. I mean, the project to fix this was actually initiated way back in 1992. In 2004, the International Accounting Standards Board released IFRS 4, but here is the absolutely crucial point to remember. IFRS 4 was merely an interim stopgap. It wasn't a unified set of rules. Actually, scratch that. It wasn't really a standard at all. It basically just allowed companies to keep using their own wildly varied local GAAP practices. It took until May 2017 for the final IFRS 17 standard to actually be issued, eventually becoming effective on January 1, 2023.
That 2004 stopgap created a totally fractured landscape. It led former ISB chairman Hans Hugerfors to famously state that a new standard was desperately needed to combat accounting anarchy. And anarchy is kind of hitting the nail on the head. Under IFRS 4, comparing two multinational insurance companies was practically impossible for investors. One company might recognize all its expected profit the literal moment a policy was sold, while another might spread it out over 20 years. It was a massive barrier to true financial comparability.
Which brings us to Part 2. Enter IFRS 17.
The paradigm shifts fundamentally right here. Under the old IFRS 4 regime, there's this heavy focus on historical data, and like we mentioned, companies could often recognize profits right up front upon receiving premiums. Under IFRS 17, that's completely gone. The new model mandates current, forward-looking estimates with very explicit risk adjustments. Crucially, profits are no longer claimed on day one. No way. They must be recognized over time as the insurance services are actually delivered to the customer.
To achieve all this consistency, IFRS 17 introduces three distinct measurement models. The General Measurement Model, or GMM, is your default foundation, the standard way of doing things. But you know, the insurance world is incredibly diverse, so there are two alternatives. The Premium Allocation Approach, or PAA, acts as a handy simplification, specifically for short-duration contracts. Think like your standard annual car insurance policy. And finally, the Variable Fee Approach, or VFA. That one is explicitly tailored for participating contracts, those highly complex products where the policyholders actually share in the returns of the underlying investments.
Let's move to Part 3, unpacking the CSM.
The Contractual Service Margin, or CSM. This is literally the most important acronym in the whole standard. By definition, this represents the unearned profit of a group of insurance contracts, which is deferred over the life of the contract. The best way to think about the CSM is like a massive unearned profit jar. When an insurer signs a highly profitable 10-year policy, IFRS 17 strictly forbids them from taking all that profit and dumping it onto this quarter's income statement. Instead, all that profit gets locked in the CSM jar on the balance sheet, and it is carefully scooped out and recognized as revenue year by year as they actually provide the coverage.
When you break down the math of this new liability structure, it's essentially built from three distinct blocks. First up, you have the current estimate. That's the discounted value of all those expected future cash flows. Next is the risk adjustment, which explicitly accounts for the uncertainty in those cash flows because, let's face it, nobody has a crystal ball. And finally, stacked right on top is the CSM, that capitalized new business gain, representing all those unearned profits. Because companies had to set up this CSM at transition, a lot of insurers actually saw an initial hit to their equity. Those future profits had to be pulled back and parked in this new liability bucket to be slowly released into earnings over time.
But
And this is super fascinating. There is a strict asymmetry in how IFRS 17 treats good news versus bad news. For profitable contracts, like we just said, you establish the CSM and spread the profit out nicely. But what if a group of contracts is expected to lose money right at inception? These are called onerous contracts. For these losers, you absolutely cannot spread the pain over time. IFRS 17 forces insurers to recognize those expected losses immediately in the profit and loss statement via a loss component. So you spread the good news, but you are forced to report the bad news right away. It's incredibly conservative.
Moving into Part 4, Forward-Looking Risk Adjustments.
Under the previous patchwork of rules, the discount rate used to value insurance liabilities was often directly linked to the expected returns on the assets backing them. IFRS 17 completely cuts that cord. The liability discount rate is now based entirely on the characteristics of the liability itself, reflecting the current time value of money. The impact of the company's investing activities is now judged totally independently from how they measure their insurance obligations.
And you know, this decoupling was highly deliberate. Going back to Hans Hugervorst again, he noted that before IFRS 17, the devastating impact of low interest rates on long-term obligations wasn't nearly as visible for insurers as it was for, say, defined benefit pension funds. By mandating current discount rates, IFRS 17 brutally strips away those accounting hiding places. It brings harsh economic realities, like prolonged low interest rates, into plain sight on the financial statements. It's a game changer for comparability.
Part 5. The Transition Challenge.
So, because companies had to present comparative financial statements on the transition date, they essentially had to calculate their starting balances as if IFRS 17 had always existed. Think about how wild that is. The standard outlines 3 approaches to do this. The full retrospective approach, or FRA, is the default requirement. It literally means going back to the dawn of a contract's existence. But for life insurance policies written 30 or 40 years ago, the data simply might not exist anymore. If the FRA is proven to be completely impracticable, companies could then fall back to the modified retrospective approach, the MRA, or the fair value approach, the FVA.
Unsurprisingly, this created an intense, and I mean intense, operational reality. Insurers couldn't just tweak a few spreadsheets. They had to execute a massive 3-step overhaul. Step 1, their old legacy systems couldn't even capture the highly granular data IFRS 17 demands, so data collection had to be totally revamped from the ground up. Step 2, they had to implement incredibly complex new actuarial modeling engines just to calculate the CSM and risk adjustments. And Step 3, they had to carefully align these new policies with other standards, like IFRS 9 for financial instruments, to avoid creating bizarre accounting mismatches. We are talking about a billion-dollar operational puzzle for the global industry.
Finally, Part 6, A New Era.
So, what's the bottom line here? The fundamentals and the actual economics of selling insurance haven't magically changed. But the accounting, it finally reflects reality. We now have unprecedented global transparency. Investors can finally take a Canadian life insurer and compare them directly against a European life insurer with total confidence. The financial statements now provide a true reflection of economic reality, successfully stripping away the old accounting anarchy in favor of a rigorous, standardized focus on future risks, cash flows, and unearned profits.
As we wrap up this explainer, I really want to leave you with this final thought. Now that the black box of insurance accounting has finally been pried open and standardized, how will this massive shift in financial transparency alter the way you evaluate global investments moving forward? When the numbers are finally clear, it completely changes the conversation. Thanks for joining me on this deep dive into IFRS 17. Keep questioning the numbers and keep learning.